What happens when the AI boom runs into something it can't manufacture more of? For the past few years, artificial intelligence has been consuming resources at an extraordinary rate. First chips, then data centers, then electricity, land, and construction capacity. Now AI companies are competing for something even more fundamental: capital. Welcome back to Synthetic Politics. Amazon, Alphabet, Meta, and Oracle have already issued a record volume of bonds in 2026, far more than their combined total for all of 2025. Add companies like Microsoft, and AI infrastructure is becoming a major new source of corporate borrowing. For years, the biggest technology companies could fund much of their expansion with their own enormous profits. But AI infrastructure is becoming so expensive that increasingly, even they are turning to outside investors. And that brings AI into one of the oldest markets in economics: the market for capital. An interest rate is, fundamentally, a price. Businesses borrow to build factories. Governments borrow to finance infrastructure and deficits. Households borrow to buy homes. And investors decide where their savings can earn the best return. Now AI infrastructure is joining that competition at enormous scale, and we're beginning to see the market react. Earlier this year, investor orders for hyperscaler bonds were almost 5 times larger than the amount being offered. By July, that ratio had fallen below 2 times. Amazon provides an especially clear example. Its March bond offering attracted orders roughly 3.4 times the amount available. By July, that had fallen to about 1.6 times. Investors are still buying the debt. They're just demanding better terms to absorb more of it. That's basic supply and demand. When borrowers demand more capital, the price of attracting that capital can rise. And if borrowing costs rise enough, something economists call crowding out can begin. Imagine a company considering a factory expected to return 6%. At a borrowing cost of 4%, it may make sense. But if borrowing costs rise above the expected return, that factory might never get built. The AI company didn't literally take the factory's money. The changing price of capital changed which investment made sense. We've seen this transition before. As America's electric utilities expanded in the early 20th century, their infrastructure needs eventually outgrew what they could finance internally, pushing them toward bond markets and increasingly complex financing structures. Electricity didn't create new economics. As the technology scaled, financing the infrastructure became an economic challenge of its own. AI may now be reaching a similar transition. But there's an important distinction. We don't have strong evidence that AI is broadly crowding other businesses out of capital markets yet. The Bank of England examined this question in July and found little evidence of widespread crowding out so far. And today's higher long-term interest rates have many causes, including government deficits, economic growth, monetary policy, and reduced central bank bond buying. So, saying AI is driving up interest rates would go much further than the evidence supports. What we can see is the mechanism beginning to operate. AI is creating massive new demand for financing. Hyperscalers are issuing dramatically more debt, and investors are becoming more selective. There's also another side to this story. The supply of capital isn't fixed. Higher interest rates can attract investment. Capital can move across borders. And financial institutions can create new ways to connect investors with AI projects. That's already happening. NVIDIA's recently announced partnerships with major financial institutions are designed to mobilize outside capital for AI infrastructure. Financial innovation can channel capital and spread risk among more investors. But it can't eliminate the underlying trade-off. And underneath all of this is one of the simplest ideas in economics: opportunity cost. A dollar invested in one place cannot simultaneously be invested somewhere else. Artificial intelligence may change how productive that dollar becomes, but it doesn't eliminate the trade-off. The AI boom has already encountered scarcity in chips, electricity, land, and labor. Now we're watching it encounter scarcity in capital. And unlike a GPU or a power plant, capital has a price that reaches into almost every corner of the economy. The question isn't whether AI companies can raise the money. Clearly they can. It's what happens to everyone else when they start raising it at this scale. Do you think AI investment will become large enough to meaningfully affect borrowing costs across the economy? Let us know what you think below. If this breakdown was useful, hit like and subscribe to Synthetic Politics. We'll be back when there's more to report.